a great attendance here, people from all over the world. And thank you to all of you who have already subscribed to Resintel. And those of you who haven't, we hope by the end of this that you will consider. For the few of you who are still learning about Resintel, we are the market intelligence wing of the Plastic Exchange. The Plastic Exchange is a marketplace for buying and selling polyethylene and polypropylene. We have been operating it for 25 years, and we hold 10 to 15 million pounds of physical inventory on hand to guarantee the integrity of our market. Now, through that, we develop tools to help make our buying and selling and inventory decisions. And a little over a year ago, we released those tools and our analysis to the industry in a subscription service, Resintel. Quick introduction of myself. I'm Dominick Russo, the president of both the Plastic Exchange and Resintel. I've been trading resin for over 18 years, and I am the author of our daily Resin Pulse, which is a daily look at the news and events that affect resin pricing in a very casual format. My co-host, Michael Greenberg, he's the founder of the Plastic Exchange. He's been trading resin for over 25 years, and before that, various commodities in physical markets. He's the longtime author of the Plastic Exchange Market Update, which is now known as Resintel's weekly resin sites. Michael and I spend every day buying and selling resin. We feel that gives us a very unique look at the industry, both by studying the supply and demand data and then matching that to real world things that we're seeing in our daily trading. During this presentation, we'll be showing you various screens from the Resintel platform. All of these are available to our subscribers. And we actually have loaded in these dashboards so that you'll be able to use them after the presentation. Also, all of the information that we discuss has been given to our subscribers in our daily and weekly reports. If you feel that you would benefit from this timely information, consider subscribing. Enough of me rambling on here. Hello, Michael. How are you?
It's nice to see you, Dom, and thank you, everybody, for attending. We feel that of course, we know that resin is a very large cost input to most processors, and managing buying, selling, and inventory decisions can greatly affect the bottom line. Understanding where the market is at and what the market is doing can be critical. I'm happy to chat about the market. Dom, feel free, shoot me some questions, and let's go.
Yep, that's right. And as we're presenting, you all can ask questions, and after we're done, we will answer a few of those. So let's get started with polyethylene and what happened in 2025.
How about you pop up a chart? Let's see.
Yep.
Let's see what it looked like.
Okay, so let's start taking a look at, we'll just use a base of blow molding prices.
Well, 2025 began, so our Resindex blow molding price, it's a benchmark price for us. We evaluate our prices on a daily basis. And as Dom said, we carry inventory. These are the prices that are freely available for resin that is for sale right now. Past the delivery go in Houston. Export prices is different. Domestic rail cars can be different, but this is the basis of our pricing. So last year began really, just prior. December of 24 set an all-time record of 3.16 billion pounds of exports, and it really helped set the tone for the first quarter. In fact, we saw a similar, we're seeing somewhat of a similar activity already this year. Producers, they exported the heck out of the market, and They drew down inventories fairly significantly, about 227 million pounds, and entered 2025 with some confidence and with some strength, and prices began to rally. We initially saw about a 3-cent bump up during January, and the indices granted a 5-cent a pound price increase. Right in the middle of contract negotiations, there was a winter storm Enzo, which helped solidify some pricing, and producers pushed through an increase. The market continued to rise into February, but reached an interim peak as some shocks hit the system. This was really when the tariffs started coming into play, and it's exacerbated what was already becoming somewhat of a challenging export market. All the huge exports during November, December of 24, they jammed up the warehouses, and material got caught up, and there were big delays, and some major players started seeing some canceled orders. Really caused the market
to. Michael, here, I mean, you could really see on this chart here the effect that President Trump's tariff policies had on exports in April, right? So that was early April that he kind of announced his full tariff plan, and I think many thought that he would sort of do a baseline tariff rate, but instead the reciprocal tariffs ended up being a lot higher than many anticipated, right? And you can really see the impact that it had on exports from this.
Yeah, it didn't take long. I mean, we went from like 3.16 billion pounds of exports, and over the next 4 months, export sales dropped dramatically, almost 1 billion pounds per month. But producers reacted. They throttled back reactors. They reduced production. They kept inventories from overly building. But sometime during March and into April, spot offers started leading back into the domestic market, and prices began to slide. Resin prices slid about 5.5 cents through April, finishing the first cycle of the year, where we started up we rallied about 3 cents in the spot market, and then prices came off about 5.5 cents, and we're down about 2.5 cents for the year. During this time, the indices, they went up 5, and then they came off 3 in March. While we were down a couple of cents for the year, they were still up. A little bit of slippage in here, but hey, what's a couple of pennies between friends? The market started changing in April. You had a combination of ocean freight prices out of China. The China dynamic has been significant. As many of us know, they've been adding capacity like crazy, and have gone from a major importer to starting to be a very serious exporter. Somewhere around April, the closure of the Red Sea had caused a lot of Chinese and Asian resin. They had to go around the Cape of Good Hope, Good Horn, south of Africa, and it extended transit times. And by April, was really starting to catch up to the market, and freight prices with equipment was displaced, and freight prices really started to go up. And that really triggered another good, solid round of exports. A combination of Chinese prices kind of pulling back, and trade deals started to fall into place, and the market started to regain its footing, and we started a nice little rally again. Markets started going up and continued to continue going higher. Number of trade deals were starting to fall into place, but they were also getting more stressful with China and getting aggressive. Somewhere in I believe it was late May into June, the U.S. started to restrict the transit of LNGs to China, and a lot of this, most of this Chinese capacity expansion in both crackers and in resin reactors rely on the imports of low cost feedstock, and there was somewhat of a shock to the system when U.S. exports were restricted. Chinese market became very nervous. A lot of offers got pulled off the table, and they were no longer pressing the market lower to go after market share.
Yeah, and I think during that time too, we saw the tensions really flaring up on the kind of the exchange from rare earths for these NGLs, right? So I think what's really interesting is the amount that politics is really spilling over into trade now. I mean, they've always been sort of connected, but I think more than ever, trade is really being used as a political tool that we saw in 2025, upsetting these markets. So,
I mean, it's a great point, and that's continued. It's continued into 2026. I mean, you're seeing like tremendous expansion, polyethylene, polypropylene, and feedstock, cracker and PDH expansion in China, and it's supported by the government. And look, we're seeing margins in the U.S. got compressed. It was a very difficult year for U.S. polyethylene producers in particular, of course, European as well. But when you're looking at public enterprises, Dow and INEOS, Braskem, these are capitalist companies, and mounting losses create big pressures. Sure, Chinese producers want to make money, but they're really after market share, and losses can be easily financed by the government, allowing them to continue to sell even at operational losses to penetrate the market.
Yeah, and just this chart real quick just kind of highlights how the cheap ethane translates to where resin prices really are at, right? So kind of shows off how important that cheap ethane is to Chinese supply, to Chinese resin supply. They need our cheap ethane to make resin at the levels they are.
Yeah, it was a big deal. I mean, it was an absolute game changer when NGLs were restricted. Look, it caused a rally. It caused a polyethylene rally. It was significant. They were nervous, and it was a big enough deal that they countered by restricting rare earths, and rare earths being as important as they are for technology here worldwide and here in the States. It caused triggered some negotiations, and we got our rare earths, and they got their NGLs back. But it was a big enough pressure point that they negotiated rare earths against it. It was a big deal. So the market had a major gyration in June with the which was the next rally, right?
Yep. We did have a price increase in June.
The Israel-Iran war was a big deal. One of the crude rally, but our president, not a big fan of inflation, talked the market back down. But a lasting issue was kind of like perpetuating the closure of the Red Sea. And during this time, U.S.-European trade deals were agreed, and And given that transit times from Asia into Europe were getting longer and longer, Europe really came to the U.S. to buy material, and that caused a fairly significant rally to the market. The market really started coming undone when ethane started shipping back to China, and China became aggressive. It's interesting. We're talking a lot about China. We're talking a lot about exports, but the domestic market is significantly impacted by the balance between supply and demand and competitive offers. Like the domestic market is largely it's not controlled, but there's significant pricing power by the U.S. producers in the domestic market. Large processors rely on direct rail car shipments to their siding for efficiency. The rest of the world, eagerly gathers 25 kg bags, that bag splitting machines, and there's substitution. In the U.S., not so much. A company that's bringing in 20 rail cars of polyethylene is not about to start bringing in 100 containers per month of 25 kg bags. So
they're a little bit married to the delivery method of North American production.
Yeah.
Bulk rail cars sucked right into their plants. To turn the switch on to buy international supplies is very difficult just from the logistics of it all.
That's right. So U.S. producers generally have pricing power in the domestic market, and have relied, historically, very heavily on the export market to offset burdensome supplies, and when they lose their pricing power, to regain, to fix the supply-demand dynamic and regain pricing power. Over the last several years, exports have, over the last decade or so, polyethylene exports have gone from like the low to mid 20% of total sales, and are now regularly exceeding 50% of all sales. So the export market has become a very important market and a primary market.
And if we look at just LLDPE, this chart is highlighting the percentage of sales that is exported, right? So we're generally near 60% now of all linear sales go export, right? So the export market is very, very, very important to what goes on in the domestic market.
Right, and I guess one of the points here is that the U.S. producers, polyethylene producers, they don't control export pricing. International buyers, they have, even though U.S. producers have the cheapest source of feedstock in the world and can ultimately price polyethylene kind of like where they want to, they obviously want to optimize their operating rates, their volumes, manage their inventories while still getting the price. When we talk about Chinese producers going after market share and willing to take losses to do so, they don't want to sell at a loss, but they're willing to sell at a loss. And $1 billion here and $1 billion there is not that big of a deal to China. $1 billion here and $1 billion there is a big deal to U.S. producers. So U.S. producers are more than somewhat of a price taker when it comes to international markets. And we saw as the market was really transitioning, getting past 40% of total exports, exports as a percentage of total sales, we saw several periods where the U.S. producers tried to hold price and buyers had nothing, international buyers had nothing for it. And they eagerly switched and bought cheaper materials. And we saw huge inventory builds, several years back as the producers were learning that they're not totally in charge. Now, if you take a couple of billion pounds of export market,
that's the producers on the call.
But if you take, 2.5, right now they're averaging around 2.7 billion pounds of about 2.7 billion pounds of polyethylene is exported on average in a month. If you take that out of the market, the international market, they're going to feel it. We saw that in late 2020, mid to late 2024 and 2025, when there were threats of port strikes. There was a fear. There was a fear that if the market, if U.S. was not exporting polyethylene, there was a fear from international buyers, where are they going to get it? And it was significant. And it showed that the world market relies on U.S. resin, even though the price is generally set by competitive offers. Anyway, the polyethylene market saw a long price slide that lasted, July into pretty much through October. It was a significant slide, and it got really exacerbated by on August 29th. There was about a 9 to 10 cent a pound anti-dumping duty that was applied to North American polyethylene, and in order for U.S. producers to maintain their market share of the very important Brazilian market, they had to lower prices in order to remain competitive and essentially eat a very large part of the anti-dumping duty. European demand remained very strong, but they spilled blood in the water, and they kept lowering their bids. And producers, they kind of gyrated their operating rates, trying to maintain proper control of the market, of their inventory, while still growing their exports. It became more about moving volume than about price, and they chased bids all the way down. The market fell substantially. The traditional fourth quarter upstream inventory purge has been starting earlier and earlier. It used to be December deals, and then Christmas specials, and
right,
and Thanksgiving deals, and now around Halloween there was a big push. But this year it really started in September. I mean, it started early, and they started dumping the market, and it was very effective. And by the end of October, they really pushed out enough material to dramatically draw down their inventories.
And this chart really highlights what you're saying about the inventory positioning really beginning a bit earlier in 2025.
You're looking at a 2-month draw. You're looking at a 2-month inventory draw of 820 million pounds. It was the largest 2-month draw in history, aside from the 2021 freeze, which was largely because of the lack of production. This was effective. September, October, they dumped the market, and by November, sure, exports continued to grow, but the pricing was less aggressive. The spot market bottomed in October, and rose very modestly through the end of the year. We actually ended the year down. We ended the year down about 2 cents a pound. We had 2 full cycles from January through October, and started building the next up leg in late October. The indices.
You can see we bottomed in really mid-October. And from the market activity we were seeing, rail cars were disappearing quickly. What was available, those totals were lesser and lesser as we kind of got into December. Asking prices were inched up. So really, by our assessment, the spot market had really sort of bottomed before Halloween this year.
It was
traditionally, as we're talking about, usually happens November, December, right? And then we started building from here.
When the market was sliding, it was like constant, like every week, like bids were dropping, and buyers could just assume that prices were going to continue going down, and hey, eventually resin will be free. Of course not. not the case. Resin got cheap. Resin got really cheap, and volumes were strong. We had our strongest, fourth quarter was our strongest quarter ever, our highest volume trade. And even as resin got into the 30s and off-grade got into the 20s, and they're pressing for lower prices, as soon as the market started tightening up, the demand was still there because resin is historically really cheap. You look at polyethylene and polypropylene compared to other raw materials. I mean, steel and aluminum and precious metals and glass and concrete and wood. They're all expensive. They're all relatively expensive. The petrochemical complex, resin included, it's historically cheap. So even as the resin prices started to firm up, the demand was there because we are regularly selling polyethylene into Europe well below the price of ethylene in Europe before they even process it. So sure, they want cheaper and cheaper prices, but you raise the price a couple of pennies and they're still all over it. By November and December, it was, if you had the rail cars, it's no problem selling them. Cars lasted, rail cars were there for a day or less. And if you didn't grab them, they were gone. The market started chasing material. By mid-December, there was really not much available, and the producers did exactly what they wanted. It took a long time. It took like 5 months for them to regain pricing power. And they did it by controlling their operating rates, by exporting like crazy, taking the lumps where they had to. And they put themselves back in a position to get a price increase in January. There's a nickel on the table. It looks like we're a big fan of 3 cents. That's about we're up about 4.5 cents from the low. We're up about 3 cents during January. Mid-January, it looked like 3 cents was going to stick. We had our little winter freeze here again in Houston. It wasn't that big of a deal, but there was some preemptive and preventive shutdowns, and the producers they had some resolve, and they really wanted to stick to their nickel. And it looks like the nickel might really be confirmed for January. We still kind of feel the spot market is not completely taking a nickel from January on, but through February, I wouldn't be surprised if a full nickel sticks.
Yeah. So bottom line is 2025 was, we were kind of stuck in that long downtrend. Producers made some moves to kind of trim inventories, increase exports, which really set up where we're at today, right? All the while there was not really an official decrease that was recognized by any of the indices, right? So, those of you that are tracking the spot market, it's really important to see, hey, there's markets going down. There's some savings to be had by maybe pairing some of our supply in the spot market. This chart kind of highlights that, right? I mean, we have contract prices ever going higher officially, yet spot prices didn't necessarily track that last year.
For those that are closely watching the spot market, maybe one of the most important signals is when is a price increase going to take hold, and buy up all the spots that you can before if it's cheaper than your pending contract. But more importantly, when do you negotiate a discount from your contracts? There was very significant slippage last year. Contracts were up. The indices were up on the average of about 5 cents a pound. Resin prices were actually, spot prices were down about 2 cents a pound for the year. Now it's one thing to see normal slippage as traditional, but the market was directionally different. Contracts were up. The spot market actually ended down. Those that were savvy, that were deeply involved in the spot market, also knew that they didn't have to take a full nickel last January, and knew that even though the indices do not grant a a discount, a decrease during the summer, you can negotiate unofficial discounts to your contracts along the way. And they happened. But enough on that.
Right. So what are some of the things that we're looking at for 2026, right?
I think that like an overreaching theme is going to be, look, China's continuing to grow. Exports are a big deal to U.S. producers. They're a big deal. You know, they're needed to maintain operating rates, and they're not always control of the price. And you have to look at what's going on in China and have a really good feel for where really important to see, you know, where spot levels are, and that's where your deals are going to be in the domestic market.
Yeah, and just to comment on China as well. I mean, I think the general narrative in our industry is that they have so much supply coming on. They're motivated by not necessarily profit, but by being a big player in the global market. But interesting enough, you know, we find them every month buying resin from the U.S. for, you know, to be brought into China. So, you know, it's a little, it's important to kind of not always just, you know, follow the general headlines, right? And know that in between maybe some of these larger macro plays, there is little shifts that are happening.
Yeah, it's interesting because it's bold as their expansion plans have been. They're extremely vulnerable, and we've seen several times them react to the vulnerability. When you know, we talked about the ethane restrictions, they pulled out of the market. They just pulled out of the market, and the market was relieved of the selling pressure. The market started to rally, and in the last several weeks, you know, when the U.S. goes into Venezuela, China got nervous. When the U.S. puts an armada in towards Iran, China gets nervous. When Ukraine hits some of the Russian shadow fleet, China gets nervous. You put all three of those together, and they continue to recognize the vulnerability of their cheap under the market oil from sanctioned locations. And look, I wouldn't be surprised if all the Chinese expansion that is like been that's been put into place and that's been forecast and that is underway, I wouldn't be surprised if some of it doesn't finish. You know,
sure. And other assets are going to continue to be taken down that are less efficient.
Yeah, Europe has a big issue. You know, Europe and the U.S. in particular. You know, although the U.S. seems to be moving a little bit away from it, the imposed restrictions on petrochemicals and industry, it's not helpful. China doesn't play by the same rules. They're not afraid of using their coal to olefins, even though it's pricier and it's dirty. They continue to expand their coal usage. Can't do that in Europe. Can't do it here. Can't do it here in the States, and it makes a kind of like an unfair playing field. Yeah, I think Europe has a big problem. I don't think that Europe is going to be a major plastics producer, and you've seen enough multinational, polyethylene producers. Look, they make resin in the U.S. and they ship it to Europe and the Mediterranean, to Africa, and they make it seem like they're selling it to their normal clients, and it doesn't matter where it was produced. There's still continuity of supply. It just happens to be produced in the U.S.
Yeah. So we get this question, just to shift gears slightly. We get this question a lot, right? And how much of an effect do crude oil prices have on the plastics market, right? So maybe just touch a little bit how that sort of cycles and filters through to what, they're not really, here in the US, we use natural gas mostly. It's a great cost advantage that we have, but the crude price affects the global price of resin, which in turn affects the U.S. price of resin.
Sure, like the international floor price really set the international clearing price for polyethylene is generally the lowest off-grade rail car price in the U.S. And when crude rallies, the cost, naphtha-based ethylene worldwide goes up. And even though the U.S., even though, like Dom says, like the U.S. cracks ethane to make our ethylene and ethylene to make polyethylene, the world price is generally set on crude. Now, in the last year or so, year and a half, when a lot of Chinese capacity came online, it overlooked a lot of it because they're out to just sell their resin and gain their market share. If we get back into an environment where look, crudes come from the mid 50s and back into the mid 60s, yeah, $10, 16%, 17% rise. It's a big deal. It's meaningful. We said earlier, the goal of a lot of this Chinese expansion is to gain market share and to make sure that their petrochemical infrastructure is in place, so they don't have to rely on imports. Their aspirations are that they could be exporters to the world. Maybe that doesn't fully happen. We're coming in towards that inflection point, and like we mentioned earlier, they get scared of a shock to their cheap under the market supply, and they pull back offers, and offers are starting to they're taking their thumb off the market. Prices are starting to rise again, and they're buyers. So overall themes: China expansion. It's a big deal. It's affecting the market. Okay. It just is. Exports are going to continue to grow out of the U.S. They're going to be going into Europe more and more so. Mediterranean is a hot market. Brazil is going to remain very strong. We've got, of course, flowing into Mexico, a very natural market. It's Mexican imports, polyethylene exports into Mexico. They've come off a little bit, and they're not as important as a percentage of overall total exports as other export areas have grown. It's still a very, very significant market for the U.S.
So let's put a bow on PE for now. So right now we have some, momentum. Price increase goes through in January. Producers so far in February seem very serious about getting additional increases. I think we've seen years ago 3 cents was sort of the targeted increase. Now I think producers are really looking in their increases to get a nickel at a time. They seem pretty darn serious about getting an additional increase in February. Offers we're seeing are definitely up a couple pennies with limited supply. Unfortunately, ACC, who provides us with our supply demand data, they haven't released December polyethylene yet. But I think we're expecting a pretty big export month.
It's interesting. As much of a hit that the export market took in the first 4 months of 2025, by the end of the year, exports will outstrip. In 2025 are their record, and they're outstripping that which was in 2024, and it's going to continue to grow. There's a lot of capacity available, and that will continue to limit the duration of up cycles. And I also think that it's going to limit the magnitude of price increases. We've already seen it. We're generally at a lower price level than we've been in years, right? A very low price level. A price increase of 3 cents or a nickel, it's a big deal when you're like in the 30s and the 40s. A nickel is very significant. When you're at 65 or 70 cents and you add another 3 or 5 cents, yeah, it's meaningful, but it's not as a big of a percentage change. I feel that if the polyethylene price starts to really really take off unless, look, if there's like massive, production issues and the market's very restricted, production.
Yeah, unpredictable.
Yeah,
A serious unpredictable event.
But just rebalancing supply, demand, normal markets, I think that polyethylene is going to have a hard time sustaining large increases. Price goes up, someone's going to turn on them, increase their operating rates. We're going to go grab a little bit more, put a little bit more in the market. They all seem to, increase their operating rates at the same time and pulling back at the same time. But I think that we're going to see, outside of a big shock to the system. And once again, we didn't have 2024, we had a little Hurricane Beryl, not that big of a deal. 2025 skated through without an issue. People are a little bit less frightened. But, when we saw in 2021, massive, shock to the supply system, market took off. I mean, unprecedented moves. But if a hurricane or two hit the Gulf and took out a plant, a couple of reactors, it's not as devastating as it once was. Producers generally used to carry 4 or 5 billion pounds of inventory, but now they're carrying, upwards of 8 billion pounds. So if you had like a massive supply hit, I think that exports would be pulled back dramatically, and the domestic market would be served. So, unless it was like a massive long-term issue, I think that even like a supply shock would carry less of an extreme magnitude of price rise.
Right. So I think for 2026, right, we're in the middle of a little uptick, but I think in general, the high prices, we're going to see lower highs in general for the next couple of years, probably. U.S. demand, I think we're going to need to see some manufacturing data pick up. Fed seems to be, we did 3 rate cuts last year. The new chairman appointee, I'm assuming he's very friendly to cutting rates. Otherwise, I don't think he would have gotten the job. So I think until, U.S. manufacturing really rebuilds, we're going to kind of be in sort of a longer term kind of downtrend. Now, there's still going to be ebbs and flows along the way. Opportunities, prices going up, prices going down, but I think we'll see the highs a little bit lower.
We're also at a general cheap level. We often hear from buyers, the price is too high, it needs to be lower. Well, it doesn't need to be lower for your profitability. You want it to be lower, and that's okay. But processors are generally enjoying relatively cheap costs compared to other commodities, and are quite profitable at these levels. Can the market sustain a level 10, 12 cents a pound higher? Yeah, of course it can. If there was dramatically reduced selling pressure on the international market, export prices would go up. It would lift prices here in the U.S. But I think that we're in a we're going to see more Chinese capacity come on in 26 and more in 27, and it takes time to absorb it. Reactors come on at 1 million tons, 2.2 billion pounds or so at a time, and GDP growth at 2.5–3%. It takes some time to soak up that extra capacity. Yeah. So, similar to what we saw in 2017, 2018, when the U.S. was really building and bringing on new capacity. Look, the market was long, and it took some time to absorb it. Then, you had a couple of shocks to the system.
All right. Not to cut you off, but let's move on to polypropylene.
Yeah.
All right.
So polypropylene also saw a few cycles, but a major change has happened. Polypropylene pricing is largely tied to PGP, has been for years, ever since the wild swings more than a decade ago. The wild swings back, more than a decade ago, caused producers to polypropylene producers to switch their pricing from supply demand, market clearing price to PGP plus, and it was very helpful. It helped them maintain their minimally accepted margins, but something changed. The advent of PDH. And then the reason why you had such swings was that propylene had in the U.S. had always been a byproduct of ethylene production. Ethane cracking yields a small amount of propylene, and the refineries generally produce the rest. But now there's 5 PDH units in North America that take propane and turn it directly into propylene. And we have a very, very steady supply of PGP, and that has caused the PGP volatility to shrink dramatically. But starting really in around the beginning of 2024, we had an inflection point once again where enough propylene capacity, enough propylene inventory had been built that Enterprise One goes down, or the Dow PDH upsets, and it doesn't affect the market so much. In the past, that might be good for as the U.S. market was switching their reliability onto PDH based propylene. As we were going through that transition, outages were significant because the reliance was there. But now that they've built enough capacity, an outage doesn't do much to the market. And this is kind of it's kind of like the blessing that the industry asked for. We want more stable propylene. We want lower propylene prices to be competitive. But they got what they asked for. The producers got what they asked for, but the contracts have been PGP plus, and PGP is well supplied, and derivative demand has been weak, not just at the reactor, but other derivative demand for propylene has been weak, and we've been in a very long-term, once again, down cycle in PGP, and because it's PGP plus. Polypropylene prices have just continued to grind lower and lower and lower. We saw.
I mean, the PGP price is more important than ever to polypropylene buyers, right? And we, on a lot of these calls, we end up talking mostly about PGP and not so much about polypropylene, right? Because it's become that important. And really, because of the amount of PGP that is available in the market, last year we saw margins at the PDH really turn negative, which we're showing here for a whole quarter. We've seen them previously go negative, right?
Yeah, in the black you've got PDH. In the black you've got
a very small amount of time, but here we saw a large amount of time that we saw PDH margins really go negative. And there's just a lot of PGP available to the market right now, and polypropylene operating rates have generally been kept on the lighter side, which doesn't help the PGP price, right?
Yeah, there's a structural problem with PGP plus at this point. If polypropylene producers cut their operating rates to reduce their inventories and rebalance the market, the less they pull on propylene for their reactors, the lower the propylene price goes. So as they reduce production, as they reduce supply, the price actually goes down. And that's just wrong. Think about how crazy it would be if all the polypropylene producers ran the reactors at 100% for 6 months. They put the price of it, they suck up all the PGP, they put the price of propylene up, 20, 30, 40 cents a pound. They'd be stuck with an extra 4 or 5 billion pounds of inventory, and the market would be on crater in the future. But being that it's PGP plus based pricing, the price of propylene will go up, the price of polypropylene will go up. Yeah, it would kill demand, right?
Yeah, it's a delicate balance.
Yeah,
You don't want to overbuild inventories, and then resin is a wash.
So we're seeing. So what we're seeing though is we're seeing a separation at times between contract pricing and spot pricing. Spot availability has been very, very tight. As producers keep their operating rates relatively low, the prices have gone down. So contracts are relatively and historically cheap, but those that need extra material, spot truckloads or spot rail cars. Look, we're seeing spot prices higher than contracts sometimes, and it's kind of strange to see that. But when the supply demand dynamic gets tight and you need quick availability, it's availability trumps price, and the price and the premiums are there. Two changes happened. The negative PDH margins became problematic for producers. PGP contracts are generally been priced between 2.5 to 3 cents over the 30 or 45 day average of spot PGP. But spot PGP was cheaper than the cost of production at the PDH. And a lot of like Enterprise, a lot of their contracts are based upon propane. And if a U.S. polypropylene producer that buys their monomer on propane plus, they don't necessarily want to see a cheaper contract price than they're paying for their material. It's a disadvantage. And we saw in the second half of really starting, I guess, in September. As PGP prices came down, as spot PGP came down, the contract price did not come down as much. And you could see, September, October, you see that the spread of PGP contract over spot increased because contracts became based more off of propane plus than just over the spot average. Well, that was significant. And now that propane PDH margins have been reestablished, and spot PGP prices have rallied. I mean, they got down to 24 cents. They're got up to 32 3/8, back closer to 31 right now. You saw in January, the markets kind of switched back to about 2.5 cents over the price of contracts, about 2.5 cents over the price of spot, 2.3 cents over the spot average. So it could have been a little bit more, but a couple of PGP producers told us that they felt that they were being more fair to their buyers that didn't take that were gracious enough not to take all the decreases that they could have pushed for during 4Q, and it was a slightly more modest increase in January, up 2 cents. Could have been up 3. There's probably another penny or two sitting there on the market for February.
Right. If we look at just the average closing price of December PGP, right?
Yep, we're back above average.
Right.
And generally, like PGP easily could have been up 3 last month. It went up 2. Easily could have been up 3 because the last 10 days of the month you had spots above where contract is, or at least well above average above contract, and that generally leans to which way the market is trending the last 10 days of the month.
Yeah, and the December average was just a shade over 25. But if we look at this at January, right, the average bumps up just below 30.
So something that's starting to change, spot, off-grade's always been priced at a price, right? But spot prime cars have generally been PGP plus. But that started to change, starting somewhere in, maybe August, September, and into October. spot cars were starting to be priced at a price, not just on PGP Plus. And you go to a producer and say, yeah, spots at a quarter, make me cars at 8 or 9 cents over, and they're like, well, we don't want to do it. 33, 34, 35 cents. It's not a good price for us. We don't want it. Well, what's the price? Well, we want 39 cents, 40 cents for the cars. Okay, tell me a price. 38, 39, 40 cents. It was still a good price and still very workable into the market. We're starting to see like a transition back out of PGP Plus into supply, demand, price clearing. I think that's going to transition. We're starting to see it. We're starting to see more and more. While contracts are still PGP Plus, spot pricing has been more freely negotiated. And candidly, I like that. I like that trend. Like said earlier, all the benefit of all this new PGP that came to the market lowered PGP prices, and PGP Plus contracts. All the benefit went to the polypropylene buyer. Why? What was the benefit to the producers? It's not easy to make. Look, a PDH is complicated. A resin reactor, making resin is complicated, and very, very, very minimal margins to the polypropylene producers. I kind of feel for them. Polyethylene producers over the last decade and a half did exceptionally well. Polypropylene producers not so much. Polypropylene very cheap. Propane is cheap. It's all going to the processor. Polypropylene producers are still kind of suffering. Look, maybe if another PDH or two are built here in the U.S., the U.S. continues to have very cheap propane, cheap PGP. Look, the U.S. could easily be a very significant exporter of polypropylene to the world.
They haven't been yet, right? So they don't have that market to really rely on to clean up any of the extra pounds that they produce. So it's really a balancing act. And I think that's really the later in the year, I think we saw a shift in attitude, and you kind of mentioned it, where it was sort of like, hey, I think prices are cheap enough. It's not easy to run these plants and make polypropylene, right? I think we saw producers sort of take a stand in November and December to sort of put a stop to the slide.
Integrated producers found benefit though, because they had their propane, they have their PDH, and the price of PGP was skewed higher than it kind of ought to have been, right? I mean, you saw, like historically, you saw that PGP contracts were closer to 6 or 7 cents over the spot average, whereas traditionally 2.5 or 3. So in a way, they kind of like integrated producers picked up a few cents margin by almost I don't know the nice word of saying like elevating the price of PGP contracts more than maybe it ought to have been. So they found a few cents of margin anyway. And now that we're switching back into more of a 2.5 or 3 cents over spot, which I think is going to continue in here, at least for a while, unless PDH margins go negative again. I think that you're going to see, once again, you're going to see producers looking to find their way to make their margin. So I expect more freely negotiated pricing. I think that trend's going to continue. And frankly, I'd like to see it. I think it would be good for the market. And I would like to see the U.S. producers focus a bit more on exporting their polypropylene. I think it makes sense. You got cheap feedstock through, cheap, propane. Like I'm not a big fan of exporting, LNG, LPGs out to China. Why are we giving our cheap propane to China to feed their PDH so they could run their reactors with cheap feedstock and export to the world? Why isn't the U.S. doing that? The U.S. should be doing that. Not a big fan of exporting our raw materials to give it to the guys that are pressuring the market and limiting margins here in the U.S. By the way, strong ethane and propane exports squeeze that's one of the components to negative PDH margins. Like propane could have been cheaper, but propane's being exported, and there's a bit to it, and it squeezed PDH margins, and ethane margins, cracker margins too. They're pressured by like ethane's still cheap here, but you could be cracking more and running polyethylene reactors near capacity. I really don't understand why we continue to feed the main competitor on the international market with cheap feedstock. I think it's wrong. Is there a lobby?
What do you see for PGP and polypropylene prices here in the first quarter?
Well, derivative demand is bad for propylene, and the market continues to be oversupplied. And right now, look, the market popped. The market popped a good 8 cents because you had a number of you've got refinery and PDH turnarounds going on at the same time. Where we're starting to get in 1Q, you generally have stronger stronger reactor demand and some restocking. Ooh,
what's that?
Go ahead.
Oh, yeah, I just wanted to quickly show, currently we have one PDH turnaround in process in Invista's PDH. Spelled it wrong there. I'm just kind of using our map to show how you define that. So you can see their PDH unit is in the middle of a planned turnaround now, which has also contributed to the recent pop in PGP prices. Although they have come off their highs a little bit, I think at 31 today versus 31 in quarter just on Friday. So,
Dom, open up the map. Just put everything on there for a second. Take off. Yeah, pretty cool tool here. Every polyethylene, polypropylene plant in North America, most of them worldwide, on the map. All the crackers, all the PDH units. You could zoom in. You could click on any one of them. It'll tell you what the capacity is at that site. When it comes to polyethylene facility, what they make. Is it high? Is it low? Is it linear? What's the capacity per? This is very, very helpful. We've been using this map for years. It's very, very helpful when there's outages to see what plants are affected. We also keep very interesting network of supply channels. We know which distributors and which resellers buy from which producers. For instance, if right now you've got as a force majeure on high density, frac and pipe. Those processors, distributors, resellers that rely on INEOS for frac high D, they're seeing a shortage. And it's interesting for us to know how to react because look, we make a market, and we're out to buy and sell material and find the disconnects. And it's, like I said, very, very beneficial to us. It was phenomenally important to us during the 2021 freeze, and when Hurricane Beryl came in last year, it was very fast for us to know who's going to be short and go after supply from those that still have it available. Interesting tool. A lot of the tools that we have here are look. It's not always important, but sometimes it becomes very important. When you see massive inventory drawdowns, the market's getting tight, and that the producers are turning the market. Or when the market is building, inventories, when operating rates are just too high and inventory is building, the market's going to continue to slide in here. Sometimes it's very important, sometimes it's not, but the tools are always there when you need it. And by the way, it's not just fancy charts. A quick little plug, Dominick and I and our other traders and analysts, we're very, very happy to hop on the phone, discuss market conditions, what we think about the market as not just on a global basis, but really as it pertains to your company. We work with a number of producers discussing market conditions, what we're feeling in the market, and also with a number of processors, of course, not only selling material, but helping them make more strategic buying and inventory positions. And we're happy to do it. We'd like to talk the market. We like to do it in a very casual way, and we've got all the tools at our fingertips, which we happily share with you.
Right. So we're over an hour, so let's try to take some quick questions. If you haven't asked a question and wish to, please do. Michael, I don't know if you could see the questions that have come in. Will we be talking about polystyrene? No, we will not be talking about polystyrene. We do dabble in polystyrene. We used to much more, but the consolidation years ago made the market a lot less interesting from a trader perspective. We had a question back in PE with very large inventory draws, and yet the prices continue to slide. I mean, I think we kind of showed that the slide had kind of stopped. Has kind of stopped in the short term, and there's a little upward momentum now. So important to note that markets do go up and they do go down. So the resin market is not going to go to zero. So when a downtrend happens, it will eventually turn and go higher as well.
Those massive inventory drawdowns were caused by a very aggressive inventory liquidations. That's what caused the 820 million pound 2-month pull, and that was by the end of October, the 2-month pull, and it was mid-October as that was happening that the market bottomed. So very much liquidations and liquidating inventories put the U.S. producers in a strong position, and the market bottomed. So it actually did correlate extremely well.
Absolutely. Do we plan to incorporate PET in the future? Yes, we plan to incorporate many different products in the future. I don't have a timeline for that, but some engineering grades, and also, we will look to add some recycling reports in the future. I don't want to commit to the near future, but yes, we do plan on expanding to other products and more global reporting.
Someone asking here about polyethylene contracts in here. Yeah, I fully feel 3 cents in the market in January. I think that they're really going to push their 5. Maybe some companies get a TVA of a couple of pennies, a temporary voluntary allowance, a little bit of price protection. But I think that unless things change dramatically, I think that the full nickel becomes industry wide, at least by the end of February. Like you commented earlier, there's capacity on the sidelines. If prices advance too quickly, somebody starts to run a little bit harder, and the market could be fickle, and that could be it. But in the meantime, yeah, I feel like the market's on a modest. We're on a modest upswing, and I think that we'll continue to see some strength in here. I'll tell you, this is the tightest I felt the market in. I can't remember when. There's very, very little for sale right now. February pricing, spot pricing got jacked an extra 3-4 cents over 7 days ago level, and it's significant. It's significant, especially with the international market. They don't want to take it, but there's not much available. Not much resin available. We'll see if production remains under control. I think that we're gonna stick at an elevated level. I think the nickel's gonna stick around for a while. Are they gonna get more? I don't know. I don't think so, but maybe. But a nickel.
Yeah, I think the question was expanded upon to discuss discounts that large buyers quietly sneak in there.
Well, yeah.
I mean, that's when the largest buyers really can flex
Like,
their muscle, right?
how much should there be? Yeah, at least a nickel, maybe 7. Look, the market was down. Look, the spot market was down 7 was down 7 cents. The slippage between the spot market where resin's actually transacting, and rail cars are transacting. Spot rail cars are transacting that level from producer to processor. At a level that's about 7 cents a pound less than what the indices have recorded. So if the indices were up a nickel last year, there were discounts that were happening during the year and continue to build until the famous non-market adjustment comes into the market and the indices reset.
Yeah,
the answer is yes. Discounts were.
We did put that chart up, and I can put it up again. That kind of highlights the delta between spot prices and really where contracts sit. I think you and I expanded that, and it kind of does seem like we're getting to time for one of those famous non-market adjustments, right?
Yeah, which pretty much says, I'm sorry, we were wrong on pricing all the way through, but hey, let's reset and give us a chance to be wrong for the next 2 years. Okay.
All right. Looks like we have one more question. And if we didn't get to your question or you have others, feel free to reach out to us. The easiest way is probably to write sales@resintel.com. What is the current price range in the market for HOPP?
All right. So good question. It depends. Are you a buyer or seller? Good question. We're typically seeing like domestic prime rail cars around plus 11 over contract, right? Plus 11 to plus 13. Outright pricing, mid to high 40s for spot rail cars, depending who has what or what's available and who wants to move cars. Copolymer contracts, in spot pricing over monomers, generally somewhere around, 15 to 17 to 19, depending what the material is and who has it. So I would say, guys that are buying more than a couple of cars at a time are, they're somewhere in the low 50s for copolymer and the mid to high 40s for domestic prime rail cars. Spot homopolymer cars, they got off-grade homopolymer had like languished in the market. A lot of like low flow, lowish ISAC copolymer. It's always a discount. But good cars, I'm not seeing any good cars really in the 30s for off-grade. Really good copolymer cars are every bit of mid 40s and higher for off-grade. We're seeing very little homopolymer.
Sure, there's ugly cars that
ugly cars, but if you want right. Homopolymer, there's very little that starts at the 3. If you get something freight friendly and you want to buy a handful of cars, there could be some more aggressive pricing. But the whole market is kind of firmed up a bit in here.
All right. Well, let's wrap this up. We're kind of over time.
Well, thank you. I hope this was helpful. Look, not a huge public speaker. Happy to talk casually back and forth, and it's also a little bit challenging when without getting a lot of feedback. I would say, Mike, enough on this topic already. Get on to something else. We're happy to talk casually. Give us a call.
That's right. If you wanted to scan this QR code, you could schedule a one-on-one with us to kind of uniquely to talk about your business specifically. As I said earlier, all of these topics were presented to our subscribers in real time as they happened. And if you think that you'd benefit from that, please consider subscribing. But thank you for attending. We really enjoyed sharing our thoughts with you. And we will see you next time.
Thank you.
Bye.